Welcome to the Six-Figure Author Experiment, where we help you break through your first or next $100,000 goal. Parental discretion is advised. Now, let's get on with the show.
Hello, everyone, and welcome to another episode of the Six-Figure Author Experiment. Lee, did you know that people with lower voices are seen to be more authoritative when they're men, and people with higher voices are seen to be more likable? So that makes me believe that people in authority are wholly unlikable, and I don't know how to feel about that.
Yeah, I'm going to have to think about that.
Yeah. Well, while you groove on that, let's introduce our guest for today is Seth Norris, CPA and owner of Author CPA. Hi, Seth. How are you doing today?
Yeah, Russell, Haley, I'm good. How are y'all?
Awesome.
Yeah,
I just learned CPA stands for Crazy Person Accounting. So
Crazy person.
This is perfect.
Love
Amazing.
that. Love that. I'm in a group where we call ourselves the clearly professional accountants because it's anything but that.
I love it. Great. All right. So Seth is a sponsor of our Writer MBA conference, our rest in peace, and spoke at the conference. And despite the fact that I was like, how are people going to feel about like hearing about CPA and like profit first stuff for like an hour after I heard the most people have their mind blown from what you talked about in your talk.
Really?
So yeah, I was surprised because this is my jam. Like nerding out about like accounting and like data and stuff is like the thing that I love. But like to watch an entire room also fall in love with it it is so great. So I'm going to let you though introduce yourself before we get in there. So that usually we do this at like 45 minutes in, but like let's do it at the beginning today.
Hey, why not? Switch it up some. So yeah, Seth Norris, I'm a CPA. My company is Norris CPA, but we have Author CPA. We are really niching down on this. We help authors have higher profits and pay less taxes, keep more of what you make. We got started with authors. I've actually spoken in front of authors 8 times in the last 9 months. This will be the 9th time. And you're right. Like the author community is just so hungry for this information because there's not a whole lot of people speaking to it. And we got into it because we realized we needed some systems in our business and how to consistently deliver results for our clients. And in doing that, we needed kind of a specific client type. In the meantime, my wife, Jessica, her book business was really taking off. And in the process, helped her with inventory, cash flow management, taxes, bookkeeping, the whole thing. And she taught me the inner workings of the author side of things. And she was the one who told me, she's like, Seth, no one is at these conferences talking about this stuff. Like, why don't you come to Author Nation? So I did that last November. And yeah, like I was shocked at just how many people this kind of stuff resonated with.
Yeah, absolutely. Because it's one of those things where no one wants to talk about this until like they make money. And then they're like, wait, what do I do with this money now? And then they start freaking out because like they only do one launch a year and they're like, how do I make this launch like last 12 months? Like, how do I make this? How do I do all of these things? How do I file quarterly taxes? And like, do I need to file quarterly taxes? And it's like these really niggling questions that like pop up that all compound to be like, oh, I thought I was just going to put my book on Amazon, get paid from Amazon, and then like
that's it.
Like then I would have the money. But there's like all these things that you have to do with this money to make it legal.
Yeah.
We were just talking about how money and numbers can just be vibes. There's so much vibes in accounting. And there's a lot of fear. Like people avoid even looking at things like this because they have baggage from their childhood. You know, their parents always hated their paying their bills. And, you know, you just come into this with a lot of baggage. Whereas my husband treats it all as a game. He's like, oh yeah, I'm going to play this game and I'm going to win and I'm going to beat the government. And I'm like, you really enjoy this? He's like, no, I don't. But then he's like, 3rd generation spreadsheet, like SEP IRAs, defined, what is it? Pension plan, something. And there's tax credits. And he once emailed me like a month after marrying me. He was like, I'm so glad to be married to you. That was his subject line. And the body of the email was, because I get so many deductions. But I'm so happy to have someone take care of that. So I was I was like, okay, great. I guess I'm not just a freeloader because at the time I was like, I'm gonna be an author and money doesn't matter. And he was like, oh my God, how did
Yeah.
this happen?
Yeah.
We ask questions a lot like what questions do you have for us? And I almost stopped asking it because one of the most common things I hear is I don't know what questions I'm supposed to be asking. Like it's just this void. And I picture it like someone in just this pitch dark room and you don't know what's in the corners. You don't know if you even should be in the room or what to do on it. So I find like it's our job to kind of shed light into those corners to make it a little bit less scary and then help the person decide if that's the room they want to be in or if they need help getting into a different room.
Yeah. Actually, the reason that I have a CPA and I've had a CPA for so long is because like they are partially liable to make sure that the things that I send in are accurate. So like I send them information and I like do my thing. I'm like, you like whatever you're gonna put in, like you are legally responsible for partially. So I know you're not like whatever it is going to like it needs to fall above a threshold because it's not just me that's your client. It's like hundreds of other people
Yeah.
that you need to not have this headache for. So
Yeah.
whenever my tax person is like, "Can we say this? Can we do this? Is this true?" I'm like, "The numbers are right in front of you, buddy. Like whatever you think." So, I don't know. I don't know. So like I don't actually know that much about like this stuff, but the reason that I hired a CPA to do all this stuff for me every year is because like I don't have to now. I
Right,
know all
right.
of it.
Now, I would just say read that engagement letter you have with them because I guarantee there's a line in there about you're the one responsible for the accuracy and they're going to assume that it's correct. They do have a responsibility to use like professional judgment. Like if you say I bought this jet ski for my author business, like they're supposed to question that. Um, and I will say, like, I've heard of cases where CPAs were just totally fraudulent, put just fake numbers on a tax return to get a big refund, and the client was still responsible for them because the IRS said you signed it, you agreed everything on there was correct, even if someone else prepared it. So we
Yeah.
always do for every one of our tax returns like a recorded video going through things to make sure that everyone gets a chance to understand their taxes as much as possible so that you can still feel good about it and know that, like, yes, we did use our professional judgment and we do hold some responsibility for that as well.
Yeah, I have an hour with my tax person every year who's just like,
Perfect.
we're going to go through all of these things together and then
Mhm.
we're going to agree on them. But that
Yeah.
actually happened to two people I used to work with. They used the same tax accountant and the tax accountant got like up like defrauding thousands of like return like hundreds or thousands of returns, including theirs, and they had to pay all sorts of back taxes.
Yeah.
Yeah. So, maybe a happier note to
Yeah.
go in here on.
Let's talk
Yeah, let's,
about profit first and some
Yeah.
good ways of thinking about money and approaching, the light bulb in that dark room or whatever.
Mm. Awesome. I love that. I know y'all are familiar with Profit First, but in case anyone's not, Profit First is just basically a cash management system in your business. Like it's not that sexy. It's just where do you put cash and how do you spend it? Because typically what we're going to do is if there's something to spend, we're going to look at our mobile banking app and see if there's money there. And if there's money there, we're going to spend it. And if there's no money there, we're going to panic, find money, and then spend it. And then at the end of the year, we look backwards and we say, was I profitable? And like, oh, shoot, missed it. I didn't get a profit this year. When realistically, like profit is not an event, it's a habit. It's something that you have to do over and over again. Worst case scenario is you actually get to your CPA at the end of the year and they give you your tax stuff and they say, hey, you had $10,000 of profit, you have $4,000 of taxes. And you say, well, that's great. Just keep six or keep the four, send me the six and we'll be good. And the accountant says, no, like you don't actually have $10,000. You spent it all. This is an accounting profit. And so then like, how do we fix that? I don't expect business owners to learn how to read a P&L, read a balance sheet, cash flow forecast and everything else. So if we're going to do this bank balance accounting anyway, why not just reverse engineer it into something that makes sense? Like if you're not supposed to spend the money that you owe in taxes, let's actually take it out of the bank account and put it somewhere else. If you're not supposed to spend what you want to be profitable, put it somewhere else. Because like if you want to have a 5% profit margin, and so you take 5% of every sale you make and put it in a whole separate bank account and you spend everything else, you're going to have a 5% profit margin. Like it's just how it works. So profit first is just a system for basically moving money where it needs to go. But to me, like the most important part of it is it actually prescribes the percentages that you put in each account. Like how much should you put in your tax account? How much should you be paying yourself? How much should you be spending on your business? And at first I thought that those were just kind of like cute guesses on how much you should be putting in different places. And then I was the CFO of a bank for a while. And I was having to think like, I wonder if Profit First would work for a bank. There's no way. It's talking like hundreds of millions of dollars. So I pulled up the bank's report and I pulled up the Profit First percentages. And like the percentages change as your income grows to account for the fact that you might be hiring people, you might be taking a smaller and smaller role in the business. And looking at the percentages for that level of income at the bank, everything was almost spot on. So I started realizing like, oh, these mean something. Like these percentages are based on the end result you're trying to reach whenever you're running a successful business. But instead of waiting until after the fact and seeing if you hit it, we're just going to force it to be those percentages.
And what are those percentages?
Yeah.
Because part of it is like you actually are creating like 5 bank accounts, right?
Yes. Yeah. So you're creating separate bank accounts. That makes a lot of people itchy. That makes a lot of accountants itchy. But like honestly, it's just transfers, so it's not that complicated. But the percentages are you take your real revenue, and I can talk about that. But your real revenue is not necessarily all the money you bring in. It's like all the money you bring in minus what you had to pay to get that money. You take the real revenue, and the percentages would be 5% goes to profit, 15% goes to tax, 50% goes to owner's pay, and 30% goes to operating expenses.
Wow.
And the reason that works, and that would be if you're making less than, say, $250,000. And from $250,000 to $500,000, it changes to where the owner's pay percentage decreases a little bit and the operating expense increases a little bit because at that point you've probably hired somebody. So you're taking things off of your plate. You're making a smaller percentage of a bigger pie.
Yeah. Okay. So go through those again slightly more slowly because like I know people are going to stop and rewind here.
Yeah.
Got it.
So, example, Amazon money hits my account
Okay.
and I have 5 bank accounts set up. There is a checking and then a couple of savings accounts.
Yeah. So we have an income account. This is like your serving tray. Everything comes onto this plate and then it just gets allocated out into different plates. So everything comes into the income account. Now let's pretend that all you're doing is ebooks. You don't have any fulfillment fees. You don't have any inventory. Just like that is the money. So we're not going to worry about cost of goods sold yet. Everything comes in the income account, and then you move 5% to a separate bank account called your profit account. That should be a savings account because it's going to grow over time, and you should be earning interest on that. Then another 15% goes to a tax account. Again, I would make that a savings account. That way you can earn some interest on it because it's going to grow over time. Then 50% goes to owner's pay. And then 30% goes to operating expenses. So the reason that these percentages make sense, like if you look at healthy businesses, they typically have a 20 to 30% profit margin. But this is where accounting kind of falls apart. Profit is before, whenever they're looking at that profit margin, that's before paying taxes. That's before making debt payments. That might even be before paying some of your distributions. So like profit on a paper on accounting isn't true like money you have in the bank. So if we took 5% profit and 15% tax, where that tax is kind of not counted out of your profit, that gives you a 20% profit margin. So that makes sense. And a lot of people ask like, well, how come I'm doing 15% tax if my tax rate's like at least 30% after self-employment tax? The way it works out is we're taking 15% of that top line real revenue, not 15% of your net taxable profit. So I can nerd out on numbers on this if you want an example, or I can skip that. No,
let's do it.
Numbers.
All right. Like, pick something easy though. 10 grand, 1 grand, something.
Tell the story of, Happy, the profitable author.
Okay, so he gets $100,000 of profit of gross profit after like, let's say inventory costs that's in the bank account.
Whoa. You got an inventory cost. You got there's a whole bunch of questions that I have here already.
Okay, got
You
it. Let's back
said
up.
real revenue. So like
Yeah.
let us take this person has $100,000 of real revenue,
Mm-hmm.
which
There.
I don't like I'm my assumption is like that is like mostly credit card fees and other things like that. But are there other
Yeah.
things that get deducted before real revenue?
Yeah. I love this. This is my favorite part because I do this a little bit differently than maybe other profit first people would do. So your real revenue is what's left over after fulfilling the sale. So a simple example of this would be like a construction contractor, which I know is not the topic of this, but still it helps. Construction contractor gets paid, but he's getting paid for the work of a lot of subcontractors. He immediately has to pay his subcontractors. So if he got paid $100,000 but had to pay his subcontractors 25,000, he doesn't have 100,000 of real revenue. He's got 75,000 of real revenue because 25 that was never his to begin with.
Sure.
So
So you get
similarly,
$10,000 from, let's say, a Kickstarter.
okay.
And like then you have paid your editor, you have
Mhm.
paid your cover designer, you have paid your for print costs, you have paid for a fulfillment house, and you have paid for whatever the other things are, art,
Mhm.
vellum inserts, all of that stuff. And
Mhm.
you after that, your real revenue is $5,000. So
Mhm.
that is like am I understanding this
You're spot
correctly?
on. You're spot on. That real revenue after you've paid all those things is what we're going to actually base these percentages on. But be careful with things like editing and cover design and things like that, because those cost a lot of them are going to be indifferent towards how many copies you sell. So some of those things could fall in the bucket of like, these are just operating expenses. I'm releasing 2, 3 books a year. And so I'm always going to have editing and cover design regularly. And I'm going to be selling that book for years to come. And so I don't necessarily have to like subtract that every time I sell the book. But you're doing something like Kickstarter, where maybe cover design was part of the initial thing that you did if you're working with somebody who helps with that. Definitely the inventory cost. So the cost of the book that you're selling that you're going to have to replace is a very obvious like thing that you subtract before you get to real revenue, before you even make these allocations. But one thing that I like to subtract a lot of times is actually your ad spend. It's going to depend on like the ecosystem. I know you talk about that. If you're a direct selling author and 90% of your sales comes from direct sales and almost 100% of those sales are ad driven, those ad costs are going to be, 30%, maybe even 50% of your sales. You're not going to be able to fit that ad cost into a 30% operating expense bucket and be able to actually make these profit first percentages make sense. I would also argue that those are almost like a cost of acquiring the customer. And so if you spend $0 on ads and your sales plummet to zero, like that was basically a direct cost then. If you double your ad spend and your sales virtually doubled, then like it's 1 to 1 there. So I would say I'm going to subtract ad spend a lot of times from your total revenue before we get down to real revenue, as if it's a cost of goods sold. And that's not, good accounting, but it makes sense for a lot of authors where you're bringing in $500,000 of income, but you're spending $400,000 on ads. You don't have a $500,000 business. You have $100,000 business. And so we got to treat it that way in the expenses that we spend.
Right. Okay, I have a follow-up question. So, like,
Mhm.
let's say, so last year I took $50,000 and I was like, I'm allocating this to like ad spend to like customer acquisition. So, like, I was taking money that I didn't necessarily have yet because I was like making the money. So, like, how would if I were to say, because a lot of people you want to scale up.
Mhm.
I mean, I guess the underlying question is like, okay, I'm $100,000 author. I want to become $1 million author. Like, I don't have
Mhm.
$1 million
Mhm.
now, today, to like invest. I'm investing money that I like don't necessarily have as it's coming, and I don't like have it in a bank account now. It's coming in. And
Mhm.
so like I need to, double my ad spend month over month or year over year or whatever that thing. Like there's all these things that you're doing, and like I how does that fit in? Because it's something that always profit has always been a problem with me with Profit First, because it's
Mhm.
like, well, like I might spend $200,000 on ads this year, but I won't see it back for like 3 years from now.
Mhm.
So like, where's that? How am I attributing that money?
Yeah. So if you're looking at, let's say, just moderate growth, somebody who wants to grow 10, 20% per year, If that's the case, then consider the things that have to grow first before you can grow revenue. Like if you have to make bigger inventory orders, if you have to have bigger ad spend, then if you're setting aside 10% of revenue for inventory, but you want to grow 20%, start setting aside 12% for revenue, which is at 20% more. That way, you're starting to build that buffer so that you're not only replacing what you're selling, but you're also adding to it for your next inventory order. But if you're wanting to do this massive growth, then it has to come from somewhere else, because if you start taking money aside from your sales, you can't operate your business and do that massive growth. What I've seen a lot of people do is use debt. And I really, really don't like that, because if you use debt to fund growth, then that growth has to pay off that debt, and you can't use that growth to pay off future growth. So then you're getting to this bad cycle of debt where the more your business grows, the more your debt grows, and it starts to cripple you. And those payments start to cripple you. And so now you're having to operate $1 million author business as a $200,000 author business because your debt payments are so high and you can't sustain that. You can't sustain the volume of sales you have if you can't invest back into your business for help. So I don't recommend doing debt. But it has to come from somewhere. So there's businesses that can have customer finance growth. Those would be things like you get paid before you do the work, or you get paid before you have to deliver, or you get some sort of big deposit. Unfortunately, unless you're getting super creative, that's usually not the case with authors. Even if you're doing something like Kickstarter, you're always going to have upfront costs before you actually get paid out from Kickstarter. So, and a lot of times what I've seen is with Kickstarter, you're getting enough funds to make an inventory purchase that is probably a bigger minimum purchase than what you're fulfilling with the Kickstarter. Mm-hmm. So like if you have a $25,000 Kickstarter and you're selling, say, 150 books with that, you might have to make a minimum purchase of 500 books, and that might cost all $25,000 after all the other fees are subtracted. So now great, like your Kickstarter was free, but now you have 350 books to sell, and that's fine, but you still have to come out of pocket for some of that. So if you can't have a customer finance growth strategy, then you have to have a self-finance growth strategy. Again, that's one way, not a good idea. The other way, though, is either you have to invest your own capital into the business. If you have personal funds that you can invest or personal money that you can put into it, or you might just have to take a slower growth approach. So if the options would be go into debt to grow massively, or use your own funds to grow massively, and you don't have your own funds, and we're not advising using debt, then you might not necessarily be able to grow massively just yet, unless you start getting really creative about your author ecosystem and how you're plugging in different revenue streams into your model. So I would say I agree with you. The profit first systems sometimes make it harder to grow that huge scale, but it's still possible. I would say like that profit percentage that we set aside for 5%, even though that is kind of allocated over here for just savings, we can start carving some of that aside to say, you know what, I want to do maybe like 2% to savings for profit and then 3% for growth. Or I want to set aside this much of my OPEX. And so maybe I have to operate a little bit more leanly, or maybe I take that 50% owner's pay and reinvest some of my owner's pay back into the business for growth, because that's what I've decided I wanted to do with it.
Yeah. Okay. Bet on yourself. And, I think as a new author, I loved this business because I could do it so lean and mean. I got covers on Fiverr, and I grew as an author and a storyteller, and then figured out how to write books that sold. And then I advertised those books with the money they had made. I didn't, I wasn't this precise, but I didn't put infrastructure around books that weren't selling. I figured out how to write a series that would sell first, and then what I wanted to do from there. And yeah. And I also was lucky because my husband was supporting me at the time. And then I was working some random little things. So I could $500 for a website, couple $100 for editing and Fiverr covers, and then fix the Fiverr covers because they were bad, and slowly built up. And I talked to a millionaire author early on, and she's like, yes. And then you write the book, and then you get the audiobook. I was like, how? She's like, if the book makes money, you take some of that money and you invest in the audiobook. Then you invest in German. And I did that. I figured out a way to do that, and it worked.
Absolutely. And that's another thing to consider. In big corporate accounting, you would have an asset on your balance sheet called intellectual property. But in, small business accounting, like we don't do that. Like you're not even looking at a balance sheet, even if you did have that. But the most valuable thing you have access to is your intellectual property. And so if you're not using it to its full extent in a way that makes sense, like it might not make sense for somebody to necessarily drop 5 grand to do audiobook narrations if they don't have that money, if the payback period is going to be so long. But like you said, if you can come up with some sort of stream of revenue, maybe it's KU or maybe it's just doing something simple on Amazon and then using those proceeds because there's not a whole lot of cost involved to then invest in the inventory order or the audiobook or the translation.
Yeah, I will say that every month, because I'm an S Corp, which I want to talk about,
Yeah.
I pay myself.
Mhm.
And then every month I reinvest almost all of that money back into the business through like there's a debit, then there's a credit. Like as the owner, you can reinvest money into your business. And
Mhm.
so like it has to be like there's all of my money is a debit and a credit. Like this is one of the irritating parts about accounting to me. It's like, oh, well, like all of my mortgage gets put into the uh uh, uh gets debited in QuickBooks, but then I only take out like at the end of the year, 30% of that is my home office. So like that is what I actually get to write off on
Mhm.
taxes. And so it's like my business looks like I lost $70,000 this year currently at like
Right.
this moment. But like most of that is I have like uh, like because it has to be so in order to have my tax person be able to look at it and have it be simple, it has to look complicated to anyone who sees it because it's like, well, I gave myself money, but then this money came back in this way and like this money came out that way. So like
Mhm.
it seems it seems like the owner pay bucket is like if 50% of my money is supposed to go to owner pay, like that is a lot of
Mhm.
my money. That's half.
Yeah.
50% is half of the money. So like that's a lot you can and the 30 so 80% of it is going to operating expenses and owner pay.
Yes.
And so those two parts are more fudgeable than the profit part. Whereas, like, you can say, sure, I'm paying
Mm.
myself 50%, but I'm going to reinvest 40% of half this money back into the business every month. Am I understanding that correctly? Where,
Yeah.
like, the like the process of actually doing it is more important than like whether it gets reinvested afterwards. Like, it's the mindset where you get to take 50% of your money is going to owner pay. Once you
Mhm.
get owner pay, you can buy 12,000 ducks if you want. Like, I don't care what you do with it, but like the process of actually putting that 50% in the owner pay is important in and of itself.
100%. And you're absolutely right. That's just a mindset issue because a lot of people will say, like, well, wait, why don't I just leave the money in the business and not take a pay? And that's an option, but I don't like that as an option because it doesn't reinforce that habit that you should be paid for the work you're doing in the business. So if you don't operate your business in a way that allows you to pay yourself for the work you're doing in the business, then when it comes time for you to hire help, there's no way for you to figure out how to pay for that because it was something that you weren't paying for to begin with. So if you're doing your own cover designs and you want to outsource that, and so you're going to take some of what you were paying yourself to pay for those cover designs. If you weren't paying yourself anything, there's nothing to take from. Now it's a new expense rather than saying, no, I'm going to take from what I was paying myself and I'm going to give it to the cover designer. And now that's going to free up this many hours of my time. And I can use that time to now do this, which is going to generate more money than I'm paying for cover designs. And that's really a more powerful way to scale, I think, is start offloading those things that allow you to buy back your time and use that in a way that generates more income than what you're spending, if that makes sense.
I love that because oftentimes newer authors are like, how do I make these smart business decisions? Like
Mm.
moving from this, it's just me freelancing to an owner of a business. And And I like this too, because you're just getting more control over your money. And I think so many people feel out of control with money.
Absolutely. And it starts really important conversations. So if you're having to use 30% of your income to pay your taxes, then light bulbs should be going off. And if you don't have those benchmarks to know what the percentages should be, then you'll think, oh, yeah, 30% sounds like a normal tax rate. But if you're talking about 30% of your revenue before any deductions, it's probably too much. So then why are we doing that? Is it because we're using the wrong number when we talk about revenue or not subtracting inventory? Is it because we're not taking advantage of all the deductions we could, or we're not actually spending enough money on our business? Or we Yeah, or we maybe should have changed to an S corp earlier, and this indicates that we're high enough income that the percentage is getting to be too high. Same thing with owner space, same thing with OpEx. If those percentages aren't working, and I see this a lot with OpEx, if you're paying, let's say you're wanting to do 30% operating expenses and you run out of money in that account, that means you're spending more than 30% of your income on your business. So then why? Is it because you're growing and you're putting in personal contributions and it's kind of going into that? Then fine, like if that's your strategy. But maybe are you paying for things that you actually don't have a business that's big enough to afford that yet? And you have to start making hard decisions on, I don't get to have this software yet because I haven't grown into that, but my plan is to get there later. Or maybe I can't afford to do this cool course, but I want to do it later. And so I'm going to start setting aside money for that now. And it lets you start creating even more bank accounts to build the business that you want, to say, okay, I'm going to have editing expenses every year. How much is it? Well, create a new bank account called editing expenses or production costs and start putting aside money all year instead of getting to that expense and saying, like, I don't know how I'm going to pay this, but we'll figure it out.
I love that.
Yeah, I think this is one of the things that really the mindset part of this is something really important to like where my life changed when I went from sole proprietor to LLC to then like S corp, because like sole proprietorship is just like it's pretty easy to set up. Like you don't have to like really that in LLC you suddenly have to like, okay, I have pass-through expenses that go there are things, but like there are rules with an S corp that are like you have to pay yourself at least once a year. Like you got to do it. Like there's no there's no option around it. Like you can't just pull money out of your account to do this thing. And so it's like, well, I pay for a payroll service of like $40 every month just to make one payroll payment to me every month. And it's like, but like making that payroll payment and doing all of these S corp things like kind of forces you to look at things from this higher level thing, because like you are now like when you're an LLC, like there's kind of this commingling of like, okay, like your business, you're also not a business, but like with an S corp, it was like, no, your business and you are two separate things. Do you know that I have to, when I accidentally pay for something from my personal account, I have to then pay myself from my business account for those expenses, and like vice versa. I have to, so like a lot of I just did this right now where I had to like add up all the things that I paid in my personal account that were business and all of my business things that were personal, had to like see what the difference was and then pay myself out what that is. And like having to do those actions forces you to do those actions, which sounds like recursive logic, but like doing those actions is like what businesses do. And having to think about like, okay, every August, my entire career, I've had to do this stupid thing where like I have to pay myself for expenses, and I'm like, I need to just make better decisions. I need to figure out a better process for that. But then we never do. But like, I know I have to do it once a year. I know I have to pay myself once a year, and I know I need to pay myself what accounts to roughly $2,000 a month, because that is what my accountant said, and not more than $2,500 a month. Because I was like, I'm gonna pay myself $4,000. He was like, don't do that. It's too much. It's like $2,000 is fine to make all the things that you want happen, and like to like be. And I was like, oh, okay, well, like, because I was just gonna pay myself $10,000. I was gonna keep escalating that number, and it's like you don't actually like, hey, you can't afford to pay yourself $7,000 a month because like look at your business. It's like a nightmare scenario right now. But like by having to say, okay, my pay every month is between $2,000 and $2,500. And I also pay for my insurance. I pay for my insurance through through that payroll account.
Mhm.
And I pay for other things that are like reimbursable expenses that I did in that one payroll a month too. But knowing that I have to settle up once a month means I have to have a minimum of $2,000 in that account every month or $2,500 in that account because then you have to pay for taxes of both things and you have to pay like someone asked a question about quarterly taxes and I was like I don't really have to worry about quarterly taxes because I figure that out when I like every month when I pay myself when I do all these things like there's usually enough between deductions that I've taken and paying myself and then having to pay taxes on that where like don't usually have to pay quarterly taxes in that way but just doing that is important.
I get that doing it is important. I am very lost. Can we go back to S Corp versus LLC real quick for me? Remedial accounting lessons.
Yeah, love this.
When should I consider being an LLC or an S Corp?
It's funny, I actually did a whole like 10-minute video on my YouTube channel on this. It was the very first video I did because it's the most common question I get. So an LLC, limited liability company, for tax purposes doesn't exist. The IRS considers it a disregarded entity. So it's a state designation that provides liability protection against your personal assets from claims against the business. That's the extent of the legal advice I can give because I'm not an attorney. But for tax purposes, if you don't have an LLC, you're a sole proprietor, you file a Schedule C on your personal tax return that lists your business income and expenses, all of it gets subtracted out and it all gets added to your personal income, all subject to your personal tax rate. In addition to your personal tax rate, you're also going to pay something called self-employment tax. Self-employment tax is an extra 15.3% of your business net income after expenses on top of your personal tax rate. So your personal tax rate might be, say, 20%, and then your self-employment tax might be 15%. So that's like 35% in taxes on your business income. And then let's say your state tax rate might be another 5%. That's like 40% of your net income in taxes just from the business. Self-employment tax is the government's way of making you pay Social Security and Medicare. Because if that income had gone through a W-2, you would have had 7.65% withheld from your paycheck to pay for Social Security and Medicare, and your employer would have matched that same exact amount on your behalf. But as a self-employed person, since nothing's going into Social Security and Medicare, you have to pay both the employer and employee portion of that through self-employment tax. If you're an LLC, it's exactly the same. Your tax return does not look any different. But if you're an S Corp, there is a difference. If you're an S Corp, then you actually file a separate tax return for your business. It's not filed on a Schedule C on your personal tax return. It files its own tax return. But that net income from that tax return still gets reported on your personal tax return as income. So at that point, it's kind of the same. Like you're still adding your net business income to all your other personal income and paying your personal tax rate on that income. The difference is that the income that comes from an S Corp is not subject to that 15% self-employment tax. So if you're paying 20% personal rate, you're only going to pay 20% on your net income. And so then like the next question is, well, how come everybody doesn't become an S Corp? And it's because, like Russell was saying, you are required to pay yourself a reasonable compensation through your S Corp. And that reasonable compensation has to go through payroll. And if it goes through payroll, it's subject to payroll taxes. And payroll taxes are the same 15% as self-employment tax. So if you're a business and before paying yourself anything, you're netting out $50,000 of income after other expenses, and you decide that $50,000 is what's reasonable compensation for the work that you do, then if you switch to an S Corp and you run that $50,000 through payroll, all you've done at that point is traded self-employment tax for payroll tax. In addition to that, now you have that payroll service you're paying for and another tax return you have to file and possibly unemployment taxes and workers' comp. And now it's not going to be quite as easy to access like an SEP, and it's not as easy to pay for business expenses out of your personal account. So you've added all this complication and costs for not saving any money and possibly even losing money by switching to the S Corp too early. So that's the main difference between an LLC and an S Corp. And so then when's that right time to switch to an S Corp? It's whenever you're earning enough, or let's say this, it's whenever you're paying taxes on enough business income so that you can subtract out what you have to pay yourself to satisfy IRS requirements and then still have enough left over that you're saving 15% on to offset those costs. So it's going to be a very personal decision depending on how much you're working in the business, because reasonable compensation, the IRS doesn't give you a calculation for. It's based on several factors and the facts and circumstances, but they're going to look at, do you have other sources of income, or is this a side gig for you? Is this your only source of income? How many hours are you working in the business? What type of work are you doing? What would you have to have paid somebody else to do that work in the business? And that's so ambiguous, but like the most important part of it is it has to be reasonable. So like it can't be $1, because the lower it is, the more taxes you're saving. But you don't want it to be like $200,000 if you wouldn't pay someone $200,000 to do the work that you're doing, because now like you're not saving any money. So the trick is to get it as low as possible without breaking the rules, essentially.
This is also a designation that you can do. If you currently have an LLC, you can choose to elect to file as an LLC or file as an S Corp. So that is the big, this is because like there's other kinds of corporate structures that you can create, C Corps and other sorts of other stuff. But that is why this specific like LLC or S Corp is like such a big question, because you get to choose. Not only you can be an LLC, but in the eyes of the government, you can file as either an LLC or an S Corp, right?
Yes. You can't switch back and forth. It's not like you can say, well, this year I made a lot of money, so I'm an S Corp, and next year I'm an LLC. But yeah, you can file a form 2553 to elect to be taxed as an S Corp if you're an LLC. You can also elect to be taxed as an S Corp if you're a C corporation, but most people aren't getting that level. So if you don't do anything, your default tax designation is going to be sole proprietor 9 times out of 10. Now, what they'll do is if you have an LLC that has multiple owners, the IRS looks past that legal designation and looks at the ownership structure. So an LLC with 2 owners is taxed as a partnership. An LLC with 1 owner is taxed as a sole proprietor, unless if you make that election later. So I've seen a lot of times, like we're having those conversations with our clients around the time that they're starting to pay taxes on, say, $100,000 of income from their business. Sometimes the conversation has to happen earlier. Sometimes the conversation has to happen later, but it's something that we keep our eyes on just to make sure that the conversation happens. And sometimes the conversation goes, hey, you did well from your business this year. Had you been an S Corp, you would have saved this much money. Do you think this is going to continue? And the person might say, no, this was a fluke. I'm taking a full-time job next month. Or no, I did this big Kickstarter. I'm not doing one. I don't have any book launches. And so it's not going to be consistent. So if it's not going to be a consistent growth, then it doesn't make sense to prematurely switch to S Corp, because then you're going to still have all those costs involved without the continuous tax savings.
Yeah. I think it also depends on how much direct sales that you do too, because there's a lot of, for me, there was a lot of factors where like, oh, I just am always going to have a lot of inventory. Like I'm always going to have like all of these things. But my main thing is like, I like to write off all my business expenses and then also get a standard deduction on top of that. And like that, by just having the ability to do that, like that's 25 or so odd $1,000 of additional write-offs that I have a year by being able to do those two things together.
So we're kind of going to wrap up soon. So can we talk about some ways to play the game to save money on taxes?
Yeah. Okay. So whether or not you're an S Corp, if you're an LLC, look at an SEP. I think somebody in the comments had asked about that. SEP is a simplified employee pension. but essentially you're allowed to put aside roughly 25% of your net business income into a retirement account. The cool thing with the SEP is you actually have until the extended deadline of filing your return to make that contribution for the previous year. So in other words, you have like all the way up until October 15th, 2025 to make an SEP contribution, and it still count towards your 2024 taxes. So like you have all this time to save up money and be able to make this contribution, lower the amount of taxes you're paying from last year. Don't make the SEP contribution before getting like a draft of your tax return, because if you just do 25%, there might be other deductions you're not considering. And if you over contribute to your SEP, you have to pull that money out or you get taxed and penalized on it. With an S Corp, you can't do an SEP except on the amount of income that you're pulling as salary. So that net income from your S Corp after paying yourself does not count for that 25%. So you're kind of limited, and you have to do it through a payroll deduction. So you only have until December 31st to make those contributions. Usually a better setup for S Corps would be a solo 401k. And so a lot of times what we'll do is we'll say, well, your reasonable salary is 25,000. Well, we're just going to wait until the end of the year and do like a bonus where all 25,000 of your pay gets deferred to a 401k. And so you get the deduction for that, and you never have to pay taxes on that money, and it meets the IRS reasonable compensation requirements. So retirement contribution is really good. Make sure you're taking advantage of home office deductions, but be smart about how you're doing it, because there's two different methods of doing home office, where one can bite you later whenever you sell the house. But it gives you the sexier deduction up front, and the other one might actually be the bigger deduction over time. It's just not as sexy.
I want the sexy deduction.
The thing is, yeah, and I mean, I know we're running short on time, and I can go through like details of it, but
You want to know what the two different kinds of these deductions are? I always been like, that's future Russell's problem for these things. Like, I want the sexy deduction now. Like, I need the IRA deduction right now, and like whether a Roth or IRA will be better in the future. Like, that's I'll shoot myself in the foot.
I have a Roth 401k.
yeah,
Like,
yeah.
Well, then, like, you got to consider too, that's some like legitimate tax planning. Is your tax rate higher now than it's going to be in the future? Like, maybe. And so maybe you want the deduction now instead of later, or your tax rate's only going to be going up, and so you want the tax deduction later. Or regardless of what tax rates do you need the deduction now, because there is a time value of money? And can you take that taxes you're saving now, reinvest it in your business, and have a 10x return rather than saving 20% on taxes? So you have to be strategic about how you're doing this. It's not just like, I save money on taxes. Like, okay, but then what? Like, what'd you do with that?
Right.
Yeah, I have a couple of talks in the Millionaires. I'd love you to link to that YouTube video to answer that question, Seth. And then I actually can answer a few of the questions from the talks that I've done in my Millionaire Author Mastermind on like retirement stuff, because
Sweet.
I sit my friends down and I'm like, are you on track for retirement? Let's talk. This is what I'm doing. I am no longer a legally, certified professional to like tell you what to do, but this is hypothetically what I would do if I was exactly you. And the way I explained it to one very cautious author who's smart, she's great. The thing about the cautious people is that they're great at budgeting. So, they're like, so like, lean and mean. My sister was one of these people. Like, she just lived on nothing. And then when she finally started making money, she saved everything. And I'm like, well, you're going to be fine. You're going to be wealthy in retirement because you have the superpower of budgeting. But my cautious author friend, I was like, some of these decisions though, like, you're going to give this money to the government or you're going to give it to your future self. And she loved that. And yeah.
Yeah. Do we have any final things that we want to that people ask that we didn't cover? Feel like all these tax things are so critical, but is there anything else maybe in like profit first or anything that like what do we miss here?
Somebody mentioned, this is super specific. Somebody mentioned research, like travel research, and I have a really good like brothel story about that, but I know it's super like niche and specific, so I hate to.
You should both write spicy romance. Go
let's do it. Let me hear that. Right. And then we have to talk about simplified pensions real quick, defined benefit pension plans.
Okay, got it.
I think maybe.
That one's not going to be as fun. My favorite tax court case, and I don't know if like everybody has a favorite tax court case, but this is mine. There was an author who was writing a book, and the book had characters who would go to brothels. And so this person said, I need to have an inside view into this. He went to Vegas, found legal brothels, and partake of services, and paid everything, did the stuff, took notes on everything, like interviewed people. He took notes about how the negotiations went. He took notes about like what they wore, all of it. And even had notes that pointed like, hey, this conversation with this person ended up being this person in the book. And this thing was this thing in the book, and could point to like income producing things. Originally, the IRS said, no, that's too, you can't use that. And so it went to tax court. And the tax court looked at it and they said, actually, he has a business motive here. And so the travel expenses to the brothel, they're legitimate. Like he showed how these experiences led to something in the book. But what they did not let him deduct were the payments to the brothel. They said, even though this is reasonable and necessary and would otherwise meet the definition of a business expense, it is so personal in nature, and he got personal benefit out of those payments that it automatically disqualifies it from being a business expense. So a tamer example that I like to give is if your character is going skydiving and you need to have some sort of insight into what's that like, if you go and interview a skydive instructor and you have cost involved and you buy him a meal and everything else, all those costs would be deductible because like that was part of the research. But if you decided you were going to go skydiving in order to get the experience and really write about it in your book, it's probably a great writing technique or writing tip or to do that, but not a deductible expense because at that point you got something personal. There was an exchange there. You got something personal that was not business related other than like the experience of it, if that makes sense.
I
I
like
actually
that.
do have a favorite court case.
Oh
Tax
my
court
God.
case.
Well, now I have two. So yeah.
I found my people.
Okay, so it because people asked about like how many years do you have to be profitable in order to like, and it used to be roughly three profitable years out of five or three out of seven or something, but like there was an artist in New Jersey who was a teacher at wasn't Princeton, but it was somewhere. I forget where it was. And she had been unprofitable for literally every year she ever existed, like her existence. You know this case, I assume, Seth. But like, and so she was like, she was selling things, like she was selling stuff and then making money. But at the end of the day, it wasn't profitable. So she sued to say, I am still on I still have a business. Like this is not a hobby. Like I am doing business related activities every year. It just so happens that for 25 years or whatever it was, like I was not profitable, but I was doing everything reasonably expecting to be profitable. And so like that, as far as I know, like the rule of how many years profitable you have to be in order to like still not lose your LLC designation no longer exists. And I can prove I've been doing this for 11 years and I've never been profitable, and I'm still a business. So
yeah. So what you're talking about is the hobby rules, where if something is considered a hobby by the IRS, you don't get to deduct your expenses, but you still have to pay taxes on that income. And one of the things they look at is how many years do you have a loss? But you just have to show the intent to make a profit, even if you didn't make a profit. So then if you can show things like I have a separate business bank account, I have an LLC, I have bookkeeping in place, I do all these things that nobody does for just a hobby, then it puts the responsibility back on the IRS for them to prove whether or not it's a intent to make a profit or there's a profit motive. I think one of the silver bullet things is if it did show a profit in 2 out of the last 5 years, then that's kind of like strong proof that obviously you had the intent to, and that's kind of where that 3-year rule comes from. But there are a lot of other ways to show the intent to make a profit, even if you're not making a profit.
yeah, it's a much better, it was not better, but like it's a much lower bar than I think most people have, because everyone that I talk to talks about that like 2 of the last 5 years or like unwanting to be considered a hobby. And I'm like, listen, if you're listening to this podcast, you probably have an intent to make a business.
Yes, the listening hours of the podcast count as work.
And it goes back to what you said about mindset. And that's kind of what an S Corp does, is it forces you to have the mindset of a business owner, because you have to put on business owner hat and then employee hat. By law, you have to do that. And so what we do with Profit First is, can we engineer that same mindset without getting the IRS involved? And maybe it does mean S Corp, but we can actually engineer that same business owner mindset of, we're going to separate money and pay ourselves a certain amount and then reinvest it in the business, so that we get in that mindset of like, this is a business and we do have the intent to make a profit.
Amazing. Well, I think that's a pretty good place to end it. Lee, what do you think?
I think
Any
it's
final
good.
words?
Forget
How
about
about that for circle back?
forget about the pension. Like, too detailed. Ask your CPA. Seth, we'd love your contact details so people can like find you, book a call with you, watch all your YouTube videos, and you're welcome to post the Millionaire Author Mastermind group.
Sweet.
And just be like, this is not legal advice, but
Like, here's what you Yeah. I think the easiest way to find me is to just go to authorcpa.com. It's a constantly evolving site. And so right now you can find our YouTube channel on there, which is also Author CPA. There's also a little Profit First course on that page. And at the bottom of almost every page I have is a contact form. So authorcpa.com is a great place. And then my email address is long and nasty, but it's seth@northcpafirm.com. So that's not as fun to remember, but authorcpa.com will get you where you need to go.
Awesome. I love it. Lee, we kept on track the whole time. We did it. We've done it.
If it was going to be any episode, it would have to be this, right? With all the money buckets.
Yeah, absolutely. All right, Seth, thanks so much for joining us, and we'll talk to you soon.
Looking forward to it. Thanks, guys.
Thanks for listening. For more, head on over to sixfigureauthorexperiment.com for archive access, resources, and more. We'll see you next time.